So good morning friends. In today's video, we are going to see about a concept called as volatility. What volatility is and what are the different types of volatility that are there in the stock market. So to start, we'll have a brief discussion of about what volatility means actually. So if you look at this particular diagram, the line that is here is called as a mean value of the stock, or you can keep it as the average value of the stock. So mean value of a stock could be calculated for days or months or years. And this is the trend of the particular stock. So the trend is either picking up or going down, but whether it moves up or down, it always crosses the mean value of the stock. So now, when I say that a particular stock is volatile, I don't mean that the particular stock is having a negative trend. Volatility simply means that your stock is deviating or fluctuating farther away from your mean value. But the direction of the deviation could either be positive or could be negative. I can see the trend. Some of the peaks are positive, where again the stock is still volatile. Some of the peaks are in the negative trend. Again, it's volatile. So volatility does not give you the direction in which the stock moves. It does not tell you whether the stock is moving towards a positive or a negative trend. It only tells you that the fluctuations are quite farther away from the particular mean value. So now keeping this in mind, what are the different types of volatility? So when I talk about the different types of volatility, we basically have three types that we have to understand. The first one is called standard deviation, which measures the historical volatility, or the second one is called as a beta, which measures the relative volatility, and the last one is the implied volatility. Now we'll go one by one. So whenever I talk about measuring volatility, the first very simple measure studied by statisticians is standard deviation, which is nothing but a measure of the past volatility of a particular stock. I can calculate standard deviation for yesterday on a daily basis, or for the past 30 days of a particular stock, or for the past 60 days, or for the past 1 year, and so on. It is only going to give me an image or an idea about the past volatility of the stock. So say for example, I've written 5 here. The standard deviation of a particular stock is 5. It simply means that the stock is 5 points away from its mean value. In the sense, 5 points could be in the positive or in the negative direction, plus or minus 5. So that is how I interpret my standard deviation, and there is no such thing as a good standard deviation or a bad standard deviation. It is a descriptive statistics which only gives me a descriptive value which I cannot compare or relate to another stock. Maybe I can compare it with the peer or the competitors of the same industry, but still it does not give me a fulfilled measure of how a particular stock is going to act in the present or in the future, because stock markets are always unpredictable. I cannot take the measure of a past data of a past volatility and assume that the stock is going to move in the or going to be in the same volatile direction as it was in the past. So you can take standard deviation, like you can Google any stock standard deviation very easily. You will get the standard deviation. This is, for example, I've Googled and kept standard deviation of HDFC Bank. So you can simply Google it and you can get it. Next thing is beta. So beta is a measure of relative volatility, and as the word relative appears here, you might have assumed it is a measure of comparative volatility. So with what I'm going to compare? I'm going to compare a particular stock's volatility with the industry volatility. Say we'll take the same example of HDFC. I've gone into the portal of Money Control now. So you can see the value of beta, which is 1.03. This is for HDFC. Okay. So now what this 1.03 means? If a particular stock's value is lesser than 1, it means that the industry is volatile, but the stock in the very same industry is not that very volatile. In the sense, this example is of HDFC. So HDFC is in the banking sector. So banking sector is volatile compared to HDFC. That's what a value lesser than 1 would mean. If the value of beta is equal to 1, it means that the industry's volatility is the same as the stock's volatility. Now here, if you take the value is more than 1, it is 1.03. So it is a 3% increase over the industry's volatility. So I can say that my industry's volatility or my stock's volatility is higher than that of my industries by 3%. So 3% could be plus or minus 3%. So this is a useful measure used by investors where you can use the value of beta and see how volatile the particular stock that you're investing is in compared to the beta value or the industry volatility of the particular industry. So now the third measure of volatility is implied volatility. So far we spoke about historical volatility. We spoke about relative volatility. Implied volatility denotes the current or expected volatility of a particular stock at a point of time. So this is not futuristic in nature. This is not past oriented. This is the current ongoing expected volatility of a particular stock, mostly used by option traders. So if at all I want to check the implied volatility, I can easily go to Nifty option chain, which will give me the IV, implied volatility of the 50 Nifty 50 stocks that are being traded. So you can look at the column here that's called IV that gives me the implied volatility values. So say for example 36.52 is this particular stock's volatility's value. All these are actually option contracts. So I'm just giving you an example here. So 36.52 means that this particular stock's current implied volatility is somewhere deviating between 36% plus or minus 36% deviation is possible with respect to this particular stock. Again, this speaks about option contracts. I'm just giving it to you as an example for a particular stock. Now, this implied volatility is used in the calculation of something called as India VIX index, which is again an index to track the volatility of the Nifty 50 option contracts. So this is again used by option traders. Say for example, I go to India VIX now, India VIX index. Current India VIX is 14.32, which simply means that Nifty 50's volatility can be 14.32 plus or 14.32 minus for the next 30 days. So using my implied volatility, I try to calculate Nifty 50's volatility for the next 30 days. So India VIX index kind of gives me the prediction for volatility for the next 30 days. So generally a 15 to 30 percentage point value of India VIX is always considered to be ideal, but still then usually in uncertain situations, the value might even go up. So what exactly is an India VIX index now? India VIX index is called as a fear factor. So whenever there is fear or confusion or uncertainty in the market, the India VIX index will go up. Whenever the market is in normal terms, India VIX index will come down. Again, please note, India VIX index will not go up just because the stock's value is falling. No. India VIX index will go up only if there is fear in the market regarding their investment, uncertainty in the market, confusion in the market. For example, around elections, if you take, India VIX index always used to go up, and after the announcement of results, India VIX index used to drop down because during elections there might be confusion and fear in the market about their investments, about the possible regulatory changes, about the possible tax changes which could have a huge impact on their investment, because of which uncertainty arises and India VIX would go up. So after result announcement, once everything is clear and settled, India VIX again drops back. So this India VIX is a measure of future volatility for the next 30 days, which is again prominently used by option traders. So through this video, I hope you understood what volatility is and what are the different measures of volatility and how to use it. So we'll meet in the next video. Thank you.